If you are 35 years old and you want to retire when you turn 65, that means you have 30 working years ahead of you to build your financial foundation for retirement. Now, if you don't feel like you've advanced far enough towards your financial freedom planning or your retirement planning, I want you to watch this video until the end, because not only will you understand what you can do, you'll know how you can get there. So let's run through a few scenarios. If you have 30 working years ahead of you, let's assume that you can put aside $100 a month for your financial freedom, your retirement, whatever you want to call it, or $500 a month versus $1,000 a month versus $2,500 a month for all the big ballers out there. And let's assume that you can get an average 8% return on your money every single year. Meaning you take this money and you're going to put it into some sort of investment account and you're going to average 8% a year. This does not mean that your money has to grow by 8% a year. This means this will be the average, because no asset class, stocks, real estate, business, it does not matter, can go straight up forever. You see booms and busts. If you put $100, $500, $1,000, $2,500 a month into your investments and you can get an 8% return, that means your $100 a month is going to grow to $146,000. Your $500 a month is going to grow to $734,000. Your $1,000 a month is going to grow to $1.46 million. And your $2,500 a month is going to grow to $3.6 million. Now we'll talk about how to invest your money to get better returns and how you can invest more dollars every single month. But before we get there, you have to also understand how much money will you need every single month when you hit that 65 years old or retirement age, or when you don't want to go to work anymore, because $1 today is not going to be worth the same as $1 30 years from now. And what we've seen, or we can predict forward, is that if inflation stays at around 2.5% over the next 30 years. Yeah, we're going to make an assumption here that inflation is going to fall, but if inflation stays at around 2.5% for the next 30 years, that means that the cumulative inflation over the next 30 years will be 113%. That means if you need $50,000 a year to live your life financially free today, that means in 30 years, you will need about $106,000 a year to live a $50,000 a year lifestyle today. Now we're going to go over how you can get better returns on your investments and how you can find more dollars to invest every single month. But this is where the next thing you need to do is understand how much money will you need to live financially free 30 years from now. And you can start by asking the question today: how much money will it take you for you to be financially free today and not have to worry about going to work or getting an income? Let's just say that you need $50,000 a year today to be financially free. Well, that $50,000 today is not going to buy you a $50,000 lifestyle 30 years from now, because, well, our value of our dollars is dropping because of inflation. And so if we average now inflation at 2.5% a year, if we assume that inflation is 2.5% a year for the next 30 years, that would mean that between now and 30 years from now, the cumulative inflation will be right around 110%, assuming 2.5% inflation a year. That means that if you need a $50,000 a year lifestyle today, you would need about $110,000 30 years from now to buy you what $50,000 can today. Now we can start working backwards, because if you need $110,000 a year 30 years from now, how much cumulative wealth will you need in order to be able to fund this $110,000 a year lifestyle? Now remember, this $110,000 a year is 30 years from now money, because $50,000 today will buy you a whole lot more than what $50,000 will 30 years from now, just like how $50,000 30 years ago could buy you a lot more than what $50,000 can today. Now I'm going to go over different ways that you can get better returns on your investments and different ways that you can find more dollars to invest every single month. But the next thing you want to understand here is how much money will you actually need for you to be able to live financially free 30 years from now? And the way that you can answer that question is by first answering, if you were to quit your job today, how much money would you need to live financially free right now? And if we assume that that dollar number is $50,000 today, that if you had $50,000 of passive income today, that you could quit your job and live financially free, how much money would you need 30 years from now in order to live that same lifestyle today? Because your $50,000 today is going to buy you more than what $50,000 will 30 years from now because of inflation. I mean, just think backwards 30 years. $50,000 30 years ago would buy you way more than what $50,000 can today. So how do we not project forward? Well, let's assume now that we see inflation averaging at 2.5% over the next 30 years. That means over the next 30 years, the prices of things rise by around 2.5% a year. If that's the case, that means the cumulative inflation over the next 30 years would be right around 110%. So if you need $50,000 a year to live a financially free lifestyle this year, that means 30 years from now, you would need right around $105,000 a year to live a financially free lifestyle. This $105,000 a year 30 years from now would buy you what $50,000 can today, assuming inflation averages at 2.5% a year. If inflation is higher than 2.5% a year, then you're going to need more dollars. If inflation is less than 2.5% a year, then you would need less dollars. So now we can start diving even deeper. If you would need $50,000 a year in today's time to live financially free, that would mean $105,000 30 years from now. But how much wealth would you need in order to be able to pull out $105,000 a year 30 years from now? Now, what most traditional financial planners like to use is called the 4% rule, which means you take the number that you would need a year, $105,000 a year 30 years from now, and you divide that number by 4%. So you take this 105,000 divided by 0.04, and that tells us that you would need right around $2.6 million 30 years from now to be able to live this $105,000 a year, because that means now you can pull out this $105,000 a year every year for the rest of your life, and you should be able to have enough money during the course of your retirement. Now, this is where things start to get really overwhelming, because you might look at this and say, okay, if I need $2.5 or $2.6 million to be able to retire and be financially free, right now I have nothing or next to nothing or very far from that. How much money would I need to put aside in order to get me here? Well, then you look at these numbers and you say, oh man, I'm going to have to invest a lot of money a month in order to get me to that $2.5 million figure. And now the question is, well, what do you do? Option one is maybe I'll just live smaller in retirement, or maybe I'll take another job in retirement, or maybe I just won't retire. And option number two is planning with your money today. So what we're going to talk about now is how do you plan with your money today? Because, well, if you just want to live smaller, it can't really help you too much with that. Now, I know a lot of the traditional financial planning and retirement planning would look at things like Social Security to help you supplement your income. However, what you should remember, especially if you're under the age of 45, is that your Social Security checks are not going to really give you that financial freedom that you're looking for in retirement. Yeah, you'll probably still get them, but I would not rely on Social Security income if you want to be able to retire financially free. I want you to be able to build your own financial freedom, your own financial wealth. That way you can live your life the way you want without having to rely on that check from the government. If you get that Social Security check, well, that's just icing on the cake. I want you to build your own financial freedom and your own wealth. That way you can live life on your own terms, because, I'll give a little rant right now. I'm not a huge fan of the traditional idea of retirement. There's a saying that goes, those who retire early die early, because when you go from working a job and doing something every single day to then sitting on your butt and watching TV every day, you go miserable because now you feel like you have no purpose. So I want you to also work towards building something, creating something, finding a passion, finding a purpose, finding a hobby. That way you can stay active, but you want to be financially free. That's the goal. The goal is to do nothing. The goal is for you to be financially free. So let's talk about how you can do this, because if you want to be financially free, there's 3 factors that will determine that. TRD. Time, return, and dollars. When it comes to building wealth, it's all about taking some of the money that you earn and putting this money to work, investing this money. But in order to actually see that wealth with the investments, there are 3 factors that will determine how wealthy you will become. How much time your money has to grow, because the more time your money has to grow and compound, the wealthier you will become. Second is the return that you get, meaning how fast can your money grow. The faster your money grows, the wealthier you will become. And number 3 is the dollars. The more dollars that you can invest, the wealthier you will become. So now, what can we change? We can change the return that we get, and we can change how many dollars that we invest, but you cannot change the time. We cannot go back and start investing 10 years ago, 20 years ago, and this is where now you have to understand time is so important, which means it's better to start now rather than complaining about before, and it's better to start now than waiting until next year or the year after that. You have to get started. And if you're under the age of 35 watching this, congratulations. Start investing sooner rather than later, because the advice that pretty much anybody will tell you is, I wish I started investing sooner. Whether you're 35, 45, 55, 25, even 15, it does not matter. The longer time and money has to grow, the less dollars that you need to invest in order to build a larger piece of wealth. So we cannot control the time. So I'm not going to talk about this besides you want to start investing sooner rather than later. Then we can control the return and the dollars. So let's start by diving into here, the R, the return. Now, I do want to let you know that if you are interested in learning more about how do you build your wealth, how do you invest your money, my team at Briefs Media put together this amazing ebook called How to Build Wealth as an Investor. And this ebook starts with the basics of how do you build the mindset of an investor, to then how do you save your first couple $1,000s, to then how do you start investing in money, how do you generate cash flow. This ebook is completely free and has tons of value. And then even beyond how do you invest your money, it also goes into how do you spend your money smartly, and how do you earn more money, and how do you protect your assets. There is a ton of value provided in this ebook, and you can read this ebook for free. So if you want to get a copy of this ebook for free, all you got to do is click the link down in the description below, or go to briefs.co/ebook and you can get a copy of this ebook for yourself. Now, when it comes to how fast you can grow your money, what ends up happening to a lot of people is when you feel like you're behind, when you feel like you're not where you want to be financially, it's very easy to kind of feel desperate and look for desperate measures to grow your money quickly. Whether it's going to the casino, whether it's playing the lottery, whether it's doing the get-rich-quick schemes, and just throwing your money into something that can double your money quickly, that can make you a lot of money quickly. That's what a lot of people end up doing, because you feel like, oh my God, I'm falling behind. I need this money right now. And what ends up happening a lot of the time, most of the time, the vast majority of the time, is you're going to end up losing that money. And the reason why is because you're playing a high-risk game. The higher the risk, the higher the probability you will lose your money. But if you do win, you could win a whole lot of money. Like if you win the lottery, you can win millions and millions of dollars. But the problem is you're probably not going to win. So now, when it comes to you trying to improve your returns, there's a few things you want to understand. Number one is more risk comes with more potential return, but more risk also means that you can potentially lose your money. And this is where you want to be able to balance the risk with the reward. Because now, when it comes to risk, you can put your money into a savings account and get a little bit of return and be pretty much guaranteed. I mean, as long as you're protected by FDIC insurance, you're pretty much guaranteed to get that money unless the whole economic system implodes. So if you put your money in a savings account, you're going to see a little bit of a return, but it's next to nothing. Same with putting your money into a certificate of deposit. Low risk, low return. And this is where then you have more what I like to call the passive investments. Things like the stock market, things like real estate. And that's where the majority of wealth is built. Real estate and stocks. Now, what I want you to understand now about investing your money into real estate and stocks is that within these two categories, there's a lot of subcategories on how you can increase your returns and decrease your returns. But before we get into that, there is one third option here. If you really need to increase how much money you make, and we'll talk about that here. But option number 3 is your own business. Now, I don't recommend you go into just building a business because you just want to make a lot of money. Building a business takes a lot of work. It takes a lot of time. I saw a Dana White video recently where he talks about, oh, you want to start a business because you want to be able to control your own hours and you don't want to have a boss, and he just kind of laughs at that because when you start a business, you don't have your own hours. You work all day, every day. You don't get holidays. You are going to be working your butt off, especially for the first few years of business as you're trying to get it off of the ground. So if you want to build a business, there's nothing wrong with that. I love when people decide or want to be entrepreneurs. I love that, but you got to be willing to put in the work, because if you're not willing to put in the work, somebody else is going to come and beat you and you're never going to see the success, and it's going to make you even more miserable. I kind of used to think that anybody could be an entrepreneur. As I started to see more success on my entrepreneurial journey, I remember going through this, that I convinced a couple of my friends who were pretty decent paid employees, one of them was an engineer, to quit their jobs. Because you can be an entrepreneur and have full control. Now, of course, I was working a lot. I was putting in a ton of hours, day and night and weekends. And they did not want to put in the same effort that I did. They did not know how to manage risk. They didn't have the same drive. They didn't have the same passion. And so for them, even though they were working in the same office as me, even though I was mentoring them, even though I was trying to help them through every step of the process, they couldn't do it because they didn't care about actually building and running a business. And so if you want to run a business, that is completely fine. Actually, it's amazing. But you got to understand that building a business is hard. Building a business takes time. Building a business is risky. It's going to take a lot of ups and downs. It's going to take a lot of effort from you. So if you want to do that, it's a way for you to get a infinite return on your money, because the money you put into your business, well, you could grow that by 1,000-fold, but it takes a lot more work on your end. When it comes to things like real estate and stocks, now we're talking more like 5% to maybe 15% return, somewhere in that range, generally the 7 to 10% range. And this is where now the question is, how can you increase your returns without necessarily super increasing your risk? And this is where you have to figure out the right investing strategy for you, because the mistake that so many people make when it comes to investing is they assume that investing is a one-size-fits-all thing. And in the beginning, I don't want you to worry about all the bells and whistles. I want you to get just started. But once you get started, that's when you can start learning more about how do you invest your money smartly. It's kind of like when you go on a diet or you're trying to get healthy. What ends up happening to a lot of people is you get overwhelmed by the options out there. Oh my God, nutrition, I got to measure my macros. Oh my God, what about going carnivore? Oh my God, what about going vegan? Oh my God, should I go keto? Oh my God, should I do intermittent fasting? Oh my God, how much time should I be spending on the treadmill? Oh my God, what incline should I be on the treadmill? Oh my God, how many workouts should I do a day? What time of day should I be working out? Should I take branched chain amino acids before I work out? It can be very overwhelming. But if you want to get healthy, just start by walking more, hitting the gym, and eating a little bit less. And then as you start to get in it, now you can start to figure out what's the right diet for you, what's the right exercise cadence for you. Should you be doing HIIT workouts or whatever types of workouts you should be doing? It's the same thing with money. It can be very easy to be overwhelmed by the options out there. Index funds, mutual funds, ETFs, individual companies, derivatives, investing in crowdfunded deals, syndicate deals, investing in single-family storage units. It's overwhelming. And so this is where now, again, you just got to get started, because once you get started, you can improve. And that's where the financial education starts to come in. And so how do you get started when it comes to money? Well, first, you got to start putting money aside to invest. And we'll talk more about that here on the dollar side and how you can get more money to invest. But then you want to just start putting some of that money to work. And the more accessible option is stocks. The more intensive option is real estate. Now, the benefit that real estate has over stocks is you own a hard asset, because it's something you can see, feel, and touch. You get cash flow, assuming you do it correctly, and then you also get tax breaks from real estate that you don't get from stocks. So that's why a lot of wealthy people love investing in real estate, because you get all these different types of benefits, but it takes more work and it takes more money to get started. The stock market is much more accessible. You can start investing your money in the stock market with as little as $100, even as little as $1 nowadays, thanks to all the new technology tools out there. And the nice thing is you can just invest your money into the economy, into the stock market. Because a mistake that a lot of people make when it comes to the stock market is, I got to find the next hot Google. I got to find the next hot Amazon. I got to find the next Facebook. I got to find the next whatever. I know Google's called Alphabet and Facebook's called Meta, but you get the idea. People are trying to find the next hot stock. And when people are trying to find the next hot stock without having the right financial education, knowing how to analyze the company, of how to analyze the financials, what ends up happening is now you look at CNBC or you look on Reddit and you look at different forums on the internet, and now you get excited about people talking about this next hot stock, but by the time it hits the news, chances are you already missed the rush. And then you try to come in and chase this company, and you think you're going to be able to make a lot of money, and then when things start to turn around, you start to panic because now you're underwater, and then you're forced to sell, and then you lose money, and then you hate the entire system. So instead of trying to do that, what you can do as an alternative is you can just invest your money into the entire stock market. And there are ways to do that without having to go out and buy hundreds or thousands of stocks. For example, there are funds like ETFs and index funds. All that means is it is a basket of companies. Instead of you going out and investing in one company, you can invest in a basket with a whole bunch of companies. Like this one could invest in Apple, Meta, Alphabet, Tesla, you name it. There could be hundreds of companies into this one basket. And there are baskets that give you exposure to the total stock market. There are baskets that will give you exposure to the S&P 500, the 500 largest companies in the stock market. There are baskets that give you exposure to the Dow Jones. You might have heard of the Dow Jones. That's one of the most talked about and popular indexes or groups of stocks on the stock market. There are baskets that give you exposure to the NASDAQ. There are baskets that will give you exposure to healthcare. There are baskets that will give you exposure to dividends. There are baskets that will give you exposure to artificial intelligence. There are baskets that will give you exposure to international companies. So now, If you want to just invest your money into the stock market, but you don't want to put in the work, time, effort, research to find the individual companies, you can just find the right basket for you. For example, I'm not telling you what to invest in, I'm just giving you an example. VTI is an ETF that gives you exposure to the total stock market. So if you were to go out and buy one share of VTI, you're buying a little piece of every stock on the stock market. SPY is an ETF that gives you exposure to the S&P 500, meaning if you were to go out and buy SPY, this ETF, this will give you exposure to the 500 largest companies in the stock market. Now, when you invest in funds, what you're trying to do is you're just trying to invest your money into the economy. You're just trying to invest your money into the stock market. And when you invest in funds like this, the way that you win isn't by trying to perfectly time the market, it's by creating a system where now every time you get paid, you just put a little bit of money into the stock market. Maybe that's every week, maybe that's every 2 weeks, maybe that's every month, but every time you get paid, you want to put as much money into it as possible because now you're just going to keep just throwing your money into the market. And you want to do this whether the market's up and whether the market's down. It does not matter if you're going through a market crash, or recession, or an economic boom. You just keep putting your money into the market and you just keep letting the market do its thing, because what we've seen happen over the last century in the stock market is that we've seen recessions, we've seen market crashes, and we've seen market booms. But the people that don't understand what they're doing, they try to time the market and they're trying to find the next hot stock, many times they end up losing. But the stock market on average has grown by 10% a year over the last century, despite the market crashes, despite the recessions, despite the economic downturns. So now, if you want to get just regular returns and get the average stock market return, you can just buy the stock market and keep buying it every time you get paid. And that's a way now for you to eliminate the risk, eliminate the stress, and not have to worry about what's going on. Now, when you do that, you got to remember your strategy, because when things happen, because the problem is people forget that recessions happen and market crashes happen. They are a part of our economic system. They've happened pretty much every decade in the past, and they will continue to happen in the future. When market crashes and economic downturns happen, you have to stay sane, you have to stay calm and stick with your system. I mean, the only change maybe you would want to make is you would invest even more aggressively, because that allows you to invest into more stocks at a discounted price. But this is where now you gotta remember your strategy, not be one of the people that starts selling out of panic, but rather you keep investing aggressively even as things go down. This now allows you to get the returns of the market without having to worry about trying to find the perfect company. Now, if you're not satisfied with the returns that the average market will give you, the 7 to 10%, and you want to try to beat those returns, now you can try to turn to things like potentially mutual funds, which are now actively managed funds. These are considered passively managed funds because these are just an algorithm that gives you exposure to the total stock market or the largest 500 companies. Mutual funds are more actively managed, meaning you have a person that's managing your funds, and you're going to have to pay higher fees. So now, in order for you to get a potential higher return, you got to pay higher fees, which means it comes with higher risk, and there's no guarantee that you're going to actually beat the market. And so that's something that you're going to have to consider. Or you can also consider investing in individual companies. Now, both of these require a higher level of financial education, because now if you want to invest in individual companies, well, you got to know what is it that you're buying. You're not just buying a stock, you're buying a business. So now, how do you understand the financials? How do you understand the company's moat, meaning their competitive advantage? How do you understand their cash flow or their profit and loss? How do you understand if their revenues have been growing or not growing? This is something you want to spend your time analyzing, because now, if you want to get better returns, one of the ways to do that is by actually investing in your financial education, by investing in your learning and learning how to analyze companies and learning how to find good companies. It's going to take more time, but it's not for everybody. Now, just like that, you also have real estate as an option as well. I personally love real estate. I invest money in stocks and real estate, but I love real estate because of the three things that I talked about. You get the cash flow, you own the hard asset, and you get the tax breaks. And I can tell you as an attorney, who's not your attorney, that real estate has some of the biggest and best tax breaks that our tax code has to offer. So now, when you go out and invest in real estate, you're going out and buying a property, whether it's a home, whether it's an apartment complex, whether it's a storage unit, whether it's an office building, whether it's a retail building. You're buying this building not to use and live in yourself, you're buying it to rent out to other people. And if you do it correctly, now, the rent you're going to be generating should be enough to cover your property taxes, your insurance, your maintenance, your vacancy costs, and your management fees, and then put some money in your pocket every single month, even if you have a mortgage. And now that you're getting this cash flow, hopefully you buy this property in a good area where the property value is also rising. And hopefully, if you do it correctly, you'll also be getting tax breaks to help lower your taxable income on the money that you're generating. That's why you'll see a lot of real estate investors make money every single year but pay little to no money in taxes legally, because the tax code allows you as a real estate investor to qualify for a whole lot more real estate write-offs or deductions. And this is where now you got to figure out what's right for you. For some of you, you're going to love real estate. For some of you, you're going to love stocks and hate real estate. Some of you are going to do both. Some of you are going to have all three. And you got to figure out what's right for you. I'm not here to tell you, you got to do this one thing and buy this one thing, because I don't want you to be a sheep. I want you to be a financially educated investor. That way you can make the right decisions for you. I like investing for cash flow. The majority of my investments are for cash flow purposes because that's what I like to do. Some of you are going to hate the idea of investing for cash flow because you don't want to pay taxes on the dividends and you want to see the value investment rise even faster. That's fine. And again, you got to figure out what's the right strategy for you and what is the right asset to help you get you there. The way that you can increase your returns without exponentially increasing your risk is by increasing your financial education, because that's going to allow you now to learn more about how do you invest your money. It's going to allow you to learn more about how do you put your money to work. And it's going to teach you more about how do you actually grow your money. How do you build up financial education? Well, you can watch free videos on YouTube, listen to podcasts, you can read books, you can check out the free ebook at Briefs Media that I was telling you about in the description. Then you can invest in things like courses or programs that you will learn things online. You can go to seminars, you can hire consultants or coaches, potentially advisors, to help get you there. But it's all about investing in your financial education, and it starts by understanding that you need to make a change. So now we talked about the time that you can't control, we talked about the returns, then you have the dollars, because what we know is that the more dollars that you invest, the wealthier that you can potentially become. Because if one person is investing $100 a month and somebody else is investing $10,000 a month, obviously the person that's investing more dollars has the potential to build more wealth. So now the question is, how can you get more dollars to invest to build your wealth? And you really have two options here. You can either spend less or you can work to earn more. And let me start by talking about the spend less side, because what ends up happening to a lot of people is you realize that, oh yeah, I like this investing thing. Let's say you make $50,000 a year. And now you take $10,000 out of your $50,000 a year and you say, I'm taking a big chunk of my income, taking 20% of my income, and I'm investing it every single year. This is great. I love it. I see the wealth, but I want to get a little bit more aggressive. And so now maybe you cut back a little bit more on your lifestyle. You downgrade on your car, you downgrade on your vacations, you stop eating out, you downgrade on your home. And now you made a big jump. Now you're investing an additional $10,000 a year. So now you are investing and putting aside 40% of your income to build wealth, which is great. And this is something that you can do. It's more accessible, especially in the early stages, because now the easiest way for you to have more money is just to not let your money leave. And so now you take this money and you're investing it. Now you're investing $20,000 a month. And now you have the same question. Well, how do I invest even more aggressively? I want to build even more wealth. Well, you can keep trying to penny pinch and cut more out of this limited pie. Or option number two is you can try to grow the pie by taking it from $50,000 a year to $500,000 a year. Now, if you invest 10% of this, that means you are now investing $50,000 a year. If you invest 20% of this pie, that means now you're investing another $50,000 a year. You're investing at the same rate, but because you have a bigger pie, you can invest even more aggressively. You can build even more wealth. And this requires you now to figure out how you can earn more dollars. And notice, before we talked about earning more money, we focus on the money management side. We talk about, okay, how do you build the mindset? How do you manage your money properly? Once you know how to build the systems, once you know how to put the money to work, now it's all about putting fuel on the fire. How can you get more dollars to actually invest to build your wealth? And now, what are the options? Well, of course, we can start with your job. Can you do something to get a raise, to get a promotion, to get an upgrade at your current career? If not, can you get a career change? There's a whole bunch of certificates that you can take online to get a different job, something that has the potential to earn you more money. If that's not the right option for you, maybe you can work to get a second job. Maybe you can work part-time somewhere else. If that's not the right option for you, then maybe you have to figure out how you can get a complete new career change. Maybe you got to go back to school to learn something, or maybe you got to create your own income. Maybe now you got to work to create your own side hustle. Maybe you got to work to start your own business. Sometimes the best businesses are created out of necessity, because you have to find a way to create a new income when you find a problem that you can solve, because, well, you have to make some money. There's a problem in your life and you figure out how to solve it for somebody else and you get paid to do that. There's always ways to do that. But this is where now understanding that this is going to take more work, it's going to take more time, but it is possible for you to increase and scale your income. And you might say, but Jaspreet, there's no way I'm going to be able to make $500,000 a year. And you want to know why? It's because we have that attitude that you're never going to be able to make that type of money. If you say, oh my God, yeah, I am going to make $500,000 a year. I got to figure out how I'm going to do it. What's the next thing that you're going to do? You're going to start watching YouTube videos on how do I scale my income. Maybe you start reading books on how to build a business. Maybe you start reading books about how to scale your income. Maybe you start taking classes on how do you improve your career. But you have to start asking the question of how do you scale your income? And I don't recommend you go out and just start following those 5 steps to $500,000 a year programs, because a lot of those are just making somebody else rich. What I want you to do is really start figuring out what is a problem that you can solve? Where are your skill sets? Where is your interest? And how can you find something that aligns with your skill set and the problems that you can solve in your interest? How can you take something and now actually go out and monetize that thing? For me, when I built Briefs Media, I learned that I really enjoyed talking about money. I didn't grow up learning about money. I was discouraged from ever talking about money or really getting into the whole financial education space, which made me want to do it even more. And then I realized that I enjoyed teaching it as well, which got me onto YouTube. And then Briefs Media kind of came about because, well, just along with the financial education, you also need a way to stay up to date with what's going on in the financial news. And I liked understanding the financial news. And I also realized that a lot of the traditional financial news companies explain the financial news in a very complex and very advanced way where somebody who doesn't have a financial background can't necessarily understand. If they start talking about how 10-year treasury yields are going up and how interest rates are affecting that, well, for the average person, that doesn't mean anything. And so for me, I enjoyed breaking these things down. And that created the opportunity for me to build and scale Briefs Media with newsletters and education platforms. And so you got to figure out what is the right thing for you. You have to figure out what's right for you. What's right for you is not what's right for me. It's one of the worst things that you can ask is, what business should I start? I have no idea. What are you good at? What do you like? What problem can you solve? What are you interested in? What do you want to do? And this is where now you got to figure out how you can scale your income. That way now you can figure out the last piece to this puzzle, because now when you start to make more money, remember, you're making more money not to go out and drive a faster car. You're making more money that way you can go out and buy more assets to fuel and fund your dream lifestyle. We are facing a housing crisis like we've never seen before, and now the government is getting involved. The White House just announced a new $45 billion program to help not only create more housing, but also eliminate some of the vacancies in the office market. Let me read you a couple lines from the statement by the White House. This press statement is titled that the Biden-Harris